you got $2 million, you're going to grow for 10 years. How do you want to grow it? There's more risk, but there's more growth potential. Welcome to the Retire on Time podcast, a show all about your retirement questions. Say goodbye to the oversimplified advice you've heard hundreds of times. This show is all about getting into the nitty gritty. Now, that said, remember, it's just a show. It's not financial advice. Do your research. As always, you can text your questions to 913-363-1234, and we'll feature them on the show. David, what do we got today?
Hey, Mike, when would private equity play a role in your retirement portfolio?
Generally speaking, I think from a liquidity issue standpoint, private equity is more of a long-term play. So if you have a legacy intention and or you know you don't need to touch a part of your portfolio for at least 10 to 15 years, then private equity may make sense.
And so tell us, what is private equity exactly? What are you investing in?
So most of the equities market, as in you're buying a share of a company,
Okay.
is private. The American stock market is private. It's not public. So the stuff that you're trading on Robinhood or Schwab or whatever you're on your phone, those are publicly traded companies. And though they are massive, there are more privately traded companies. Okay, they can't be bothered by public opinion and the public stock market and how the public can really do a number on your company. So when you think of a private company, what basically is going on is that you'd have to go in or be invited to or have access to shares that are sold to you through a broker or some sort of mechanism. And I'm being kind of general on that, but you're basically accredited and you can buy into a share that's illiquid, so you can't just sell it whenever you want. They want sophisticated long-term investors that aren't going to say, oh, well, so-and-so happened and I'm out. They want to kind of restrict you so they're not as subject to the volatility of the whims of the public.
Okay, and so that's a major differentiator then between public companies and private?
Yeah, private companies might have a delay on valuing their positions correctly versus public. It's pretty quick. It's pretty aggressive. So that's that. Private, in my mind, there's really three categories when we look at private placement.
Okay.
You've got private equity buying shares of a company. So if you wanted to buy shares into XAI or shares of SpaceX, okay, there are shares out there, but you can't buy it on the public market. It's pre-IPO, so it's the public offering. That's when it becomes a publicly traded company. Like Tesla is a publicly traded company, okay? So if you wanted to buy them, you'd have to go through a fund, like an interval fund, that has already acquired shares of those companies. Think of like Cathie Wood's ARK, not the ARK ETF that's publicly traded, but the private placement version of it. So you could get exposure to these companies, but you have more hoops to jump through to get access to it.
Okay.
Private equity is a wonderful thing. There's higher risk and less liquidity. Then you've got private credit. So think of private placements on bonds.
Okay.
So this is how I like to think about it. All of the money that couldn't get, or all of the money that people needed, they couldn't get from a bank, they could just go to private equity or private credit and say, hey, I need some money and I'll pay it back this rate. And is everyone okay with that? And then you got private credit.
Okay.
I think they're riskier than your typical bond fund that would be investment grade, but everyone's different, and I shouldn't gloss over it all. There are some good ones, there are some bad ones, but you just have to ask yourself, why do they go this route, and why are they paying that rate? The higher the coupon rate, the higher the risk.
To sort of incentivize or reward people for taking that risk, they get a higher rate.
Yeah. But there's liquidity issues, so you're supposed to be a more sophisticated investor. You're taking on more risk, but you ought to know what you're getting into. And then one of the problems with, I think, private placement is some people are sophisticated and understand what they're getting into, and some people just inherited a lot of money. Now they qualify and they want to be fancy and smart, so they buy things they don't understand.
Right.
You can do just fine in the public markets. And then you've got the last category, which is the real estate private placement. So these are like, think of like a real estate fund. You have your common stock and you might buy like preferred stock. That's a private placement in some sense. You have to go through a financial advisor to get, but you're getting the payouts first before the common stockholders.
Okay.
If there's bankruptcy or anything were to happen, you are above the priority list for the common stockholders. So you have a more advantageous position to be in. There's a contract on what you're supposed to get in some situations, not all. So read the prospectus, understand the details. But because there's liquidity issues, understand what you're getting, what you expect to get back, what are the odds, and the odds are going to be kind of your expectation, not your immaculate perception of what you just want to believe, but what does your analysis suggest you should get out of this?
Okay.
And then you can get access to it. But you got to go through a financial professional to get to this stuff. You can't get it on your own, which is problematic. Here's a fun tip.
Okay.
I mean, just buy it through a financial advisor and then transfer it out and leave the financial advisor. If you have the position, what are they going to do?
Oh, right. So you would go through your financial advisor, and then you could just transfer it to your other brokerage account somewhere else.
I mean, people don't want to pay up 1% on something that's just going to sit there for 4 years. So people will give like, $100,000, $200,000 to a financial advisor, say grow it, and they've got their $3 million that they're managing, and they're just copying the trades that the financial advisor does if they feel like it. I see that stuff all the time. And frankly, I don't blame them. This idea that you're charged based on the percentage of assets you've saved. Well, how about you ask the question, how much does it cost to do the job? Maybe that ought to be a better baseline, but that's beside the point. Love private equity. I'm okay with private credit, though I think it's too risky right now. Generally speaking, there's always exceptions to the opinion. And then private real estate placement, I think, is a very wonderful way to diversify out of the stock market and the bond market in just an alternative market. And I think private placement's a more advantageous way than publicly traded stuff.
And so when would you recommend people have this in their portfolio then?
When you have legacy intention or you don't need to touch the funds for at least 10 years.
So the reason you wouldn't need it to touch it is because you already have other buckets, or you already have your income needs solved over here, and so I got this extra stuff that can just stay over here for.
Yeah, so let's assume you've got a $3 million portfolio.
Okay.
And you only need $1 million to sustain your lifestyle. You've got Social Security, maybe you've got some rental income, and then let's say you've got I don't know, you just need 40,000 left over.
Okay.
So you're taking roughly 4% or so out of that $1 million each year. That's just kind of all works for you. And you've got $2 million that you may never touch.
Oh, right. Okay.
That's where private equity would have a good place, in my opinion. Not financial advice.
Yeah.
I'm not saying just because I would do it. I rarely would entertain private equity personally.
Okay.
I like the liquidity of the public markets personally. But there are clients where private equity makes all the sense in the world. So everyone's different. But you see how it's like you don't need to touch it. It's for legacy purposes. Or maybe you've laddered out your income. So you've taken your $3 million portfolio and you've laddered out, you took $1 million and you laddered out your income for the next 10 years in this other example.
Okay.
So you got $2 million, you're going to grow for 10 years. How do you want to grow it?
Well, you could grow it this way.
Yeah.
Because it's potentially a better, bigger reward or what?
Yeah, that's a fair way to say it. There's more risk, but there's more growth potential. So you just have to balance it out. Find a portfolio that blends it nicely, that you're okay with the overall risk. And something that I think is interesting is, and humans get caught up in this, we want every one of our positions to be winners.
Yeah.
Not going to happen. So what you want to do is have this spectrum of, okay, here's the more tried and true tested, and then here's a few outliers that if they win, my goodness, it's going to be a huge payday. But if they lose, I'm still fine. And you're going to have, of all of your assets, some losers and some winners in different periods of time. I mean, how many people invested in Toys R Us? That was a winner for a while.
Yeah.
And then it wasn't.
Right.
How many people invested in Cisco? That was a winner until it dropped in 2000, and then it took 25 years to recover. Microsoft, that's a big company. Did great in the 90s, did nothing for a long period of time, and then shortly after 2012 or so, it started to recover again.
Right.
So things change. I would have hated to have been in a private placement with Microsoft in the 2000s because it didn't grow.
And you would have had liquidity issues. Is that right? Or
If it were a private equity placement,
okay,
it's
right.
not. It's a public company.
Okay, yeah.
But just by way of example,
Okay.
because I think people generally easily could look up Microsoft and watch it grow till 2000, and then basically go down and do nothing for a long-term period of time, and then eventually, like over a decade later, it starts to recover. Well, imagine if that was all illiquid. It'd be very frustrating to watch. So you have to be okay with that.
Yeah. All right. So it's not for everybody, but a good option for some.
Yeah.
Should be aware of it. Exercise all your options.
It's about understanding the tools and the appropriate placement of those tools and the willingness to say, I don't need the tool. I'm sleeping fine without this tool. So let's just leave it out. You don't need to buy a little bit of everything. Sometimes simplicity isn't oversimplified from a strategy standpoint. Simplicity is just you've got less to worry about, less to oversee, less to manage. That's all the time we've got for today's show. If you enjoyed the show, tell a friend, leave a rating, and subscribe to us wherever you get your podcast and or on YouTube. Just hit that button. As always, go to retireontime.com for resources, the book, workbook, and even you can attend one of the workshops where I build a retirement plan live. Watch me Thursday nights as I do it and answering your questions along the way. Just go to retireontime.com for that and more. Thank you for spending your time, your most precious asset with us today. We'll see you in the next show.